Good to have you here. It feels like once again going into a new year, maybe there's a soft consensus building that European stocks look cheap. Maybe it's time to bet on a market recovery with those regions rather than elsewhere. How do you think that the region is set up right now?
Well, I think the region has kind of painted itself into a very tight corner right now because the ECB is very much gung-ho on normalizing monetary policy and therefore tightening credit just at a time as all of the European economy seems to be rolling over the cliff and moving very dangerously towards the brink of contraction at this point, especially in core countries like France, where we still don't know the full extent of the economic damage done by the populist uprising that we saw over the last couple of weeks. So I think the jury is very much still out as to whether the European economy can kind of stabilize into the first quarter. The very, very best bullish case would be the following. The Europeans negotiate some sort of a Brexit deal with UK. U.S. actually begins to ease. Powell, for example, just sort of decides that he's going to not tighten any further, therefore easing credit all across the world, and Trump and Xi agree to some sort of a trade truce. If you have these three very beneficial factors develop in Q1, I think the European stocks are just bound for a very, very strong rebound. But that's a lot of ifs in that scenario. That's the bullish scenario for 2019. The much more dangerous scenario is that all of these tensions actually exacerbate, and then we could have even a much further sell-off as all the trade tensions and all the political tensions just rip the whole continent apart.
Yeah, Boris, we talk a lot about threading the needle. That's like trying to thread three needles with a single thread. Which of the three stands the best chance, at least?
I think saner heads will prevail on Brexit. Brexit right now is as much a risk for the European continent as it is for UK. And if they really, really go through a no-deal Brexit, which is going to be, of course, detrimental to the UK, but also very dangerous for Europe because Europe is a big exporter to the UK, and UK is a big supplier of financial services to Europe. And it's just, there's such an intricacy and symbiosis between the two nations that it's important, I think, for everybody to come to some sort of a consensus and create a deal. So that will be the first positive sign. If they can negotiate some sort of a Brexit deal, I think you'll see a sigh of release amongst European investors, and probably it would be a good signal for European stocks to go higher.
Boris, I want to go back to the point you just made about the ECB, because we have been so focused on the Fed and this debate about whether the Fed is tightening and tightening too fast right now. But it sounds like you're laying out the case that that has been exactly what's happening with the ECB.
No, it's exactly right. And remember, the hard part here is that Mario Draghi is set to retire at the end of 2019. So unless they really face an existential financial crisis in the region, it's going to be very hard for them to completely change gears and move to a much more accommodative stance. Even though all the conditions, all of the micro data over the last couple of months, and especially the most recent data, is showing a very, very significant fall off on demand and contraction, certainly a big decline in business sentiment as well. So I think, they're playing a very dangerous game. They're keeping a brave face and saying that everything is on target. They lowered their growth estimates mildly for 2019, but overall they're essentially trying to stay the course of normalization. And I think that could be a big policy mistake, because if they remain tight and they face this political crisis in the region in the first quarter, there is a more than 50% chance the whole region could go into a recession in 2019 and really create a much bigger problem for investors than they have it now.
Yeah, it's pretty clear that's not the scenario that's priced in just yet.
No, not
Boris,
yet, not yet.
Before we let you go, I need to get your thoughts on where the dollar's headed for 2019.
Also, really, really, hard to call right now, because so much of it depends on Fed policy and the political ramifications between U.S. and China. The problem is that there is just no good place to be right now. The dollar presumably should be the stronger currency, but what you see is that it can't even really rally, despite the fact that it has a strong interest rate yield differential against everybody else. So I think I'm relatively neutral on the dollar right now. I'm very much in a wait-and-see mode. I actually think sort of the really out-of-consensus trade, something that people are just not pricing in, is if we do have a second global financial crisis, if we have a big, big sell-off in the marketplace, the one currency that's going to just soar is the Swiss franc, which is something that I think the market is not really looking at. And that could be the big surprise of the year.